Welcome to the Economist in Your Ear podcast. So here's a puzzle. It's been 6 months since that big trade war escalation, right? And we've had constant worry about AI taking jobs. Everyone was bracing for impact, but, well, the global economy is still looking pretty solid. The question is, are we genuinely okay, or is this resilience just, I don't know, a temporary shield? Are we maybe confusing strong buffers with real immunity?
Yeah, we've been looking at a whole range of analyses trying to get a handle on this contradiction. Markets expected a slump, definitely, but forecasts for global growth next year, 2025, they're actually ticking back up towards 2.6%. So today, we want to look past those strong headlines. We need to really scrutinize why things seem so resilient, and maybe more importantly, what weaknesses that strength might be hiding.
That really is the core question, isn't it? It's about the mechanics underneath. You see the strong GDP number, especially coming out of the U.S., but when you dig into why that predicted trade war damage hasn't really shown up yet, the first thing that jumps out is, well, the tariff shock itself was more diluted than feared.
So the bite wasn't as bad as the bark, initially at least.
Precisely. I mean, the headline proposals, they suggested an effective U.S. duty maybe as high as 28% on certain imports. That sounds, frankly, catastrophic. But after all the carve-outs, some rollbacks, shifting product codes, the actual tax burden on current imports, it's closer to a little over 10%.
Yeah.
And that lower initial hurdle, it gave firms some breathing room to adapt.
Right. And that adaptation is the next piece, isn't it? Firms didn't just pass on the costs and kill demand. They got, well, strategic.
They really did. You saw companies acting fast, rerouting supply chains, that whole friendshoring, nearshoring thing we hear about. Also, critically, absorbing some costs into their margins and front-loading inventories, stocking up before tariffs could bite harder.
Okay, but doesn't that just delay the pain? It sounds like they're buffering the shock, not eliminating it.
It absolutely delays it. It pushes the consumer impact down the road, maybe several quarters. It buffers that immediate hit to consumption.
Which leads us to the elephant in the room. These massive buffers, huge government spending, especially in the U.S., and this kind of financial market excitement. Isn't that the real story? That the economy hasn't had to face the music yet?
You've nailed it. That's probably the most critical factor right now. These policy and financial cushions are, well, exceptionally thick. U.S. fiscal policy is still running hot, really stoking demand in a way that just overrides a lot of the trade friction for now. And at the same time, you've got this AI euphoria lifting global stocks. The MSCI All-Country World Index, basically a global tracker hitting all-time highs, that creates a powerful positive wealth effect.
And that wealth effect is key. People feel richer because their stocks are up, so they keep spending. Businesses see that and feel maybe a bit more confident about investing.
Exactly right. And you can see it in the market internals, too. Cyclical stocks companies whose fortunes rise and fall with the economy, think construction, durable goods, they're outperforming defensive stocks. That pattern is basically investors collectively saying, we don't see a recession right around the corner.
Okay, but let's talk about AI specifically. There's this narrative, it's pretty strong, that tech investment is the only thing holding up the U.S. numbers. How much of this resilience is just data centers?
It's definitely significant, but we need to be careful about what we mean by AI investment. In the U.S., investment in what they call IPES, information processing equipment and software. So computers, servers, software, that accounted for maybe 40% of real GDP growth recently, which is huge.
40%, yeah, that's a massive chunk from tech spending.
It is, but here's the crucial detail. About 2/3 of that is actually just normal business, plain vanilla IT refresh cycles, companies moving more stuff to the cloud like AWS or Azure. Only about 1/3 of it seems to be truly frontier, pure-play AI build-out. And importantly, if you look outside the U.S., IT isn't the main growth driver. It's more things like tourism finally bouncing back, public investment kicking in. So the story isn't just Silicon Valley.
Okay. That's a useful clarification. And on the jobs front, all the AI anxiety, yet the labor market seems, well, pretty robust, even tight in places.
The job fears, at least for now, seem overblown based on the data. The OECD countries added something like 3 million jobs in the first half of the year, and there was a review by the Yale Budget Lab which found, quote, no discernible disruption in the broader U.S. labor market since ChatGPT really took off. So if AI is going to cause massive job displacement, it hasn't really registered in the aggregate numbers yet, and that labor stability, it's a huge support for consumer confidence.
Okay, that paints a surprisingly positive picture, almost too positive. If things look this good on paper, strong GDP, stocks up, jobs stable, where do the sources say the cracks are? Because, like you said, this feels less like immunity and more like delayed reaction.
That's exactly the takeaway. We're still operating within a lag window. Think of those tariff costs like a wave that's traveling but hasn't broken on the shore yet. Just because Q3 GDP looks strong, say 3.9% annualized in the US, that doesn't guarantee Q4 or the start of next year will follow suit. That pass-through of higher costs from tariffs delays in companies' investment plans. These things can take multiple quarters to fully filter through. We really need to watch prices for tariff-hit goods, appliances, electronics, apparel, especially around the holidays and into early 2025.
Right, the clock is still ticking on that, which brings up the composition issue. That 3.9% GDP figure is great, but if it's driven by just a handful of mega companies and a big government check, that feels inherently fragile, doesn't it?
The composition is definitely the soft underbelly here. When you have growth led by just a few areas, mega cap tech profits, huge data center spending, that government fiscal push, it's much more vulnerable to shocks than broad-based growth. If one or two of those narrow leaders stumble, the whole structure can wobble quite easily. That's the risk with narrow breadth.
And surely the biggest risk tied to that narrowness is AI itself. We talked about the employment risk maybe being overhyped short term, but what about the financial risk from those sky-high tech valuations?
Absolutely critical point. That wealth effect we mentioned, it's heavily reliant on very, very optimistic valuations for AI-related companies. If those multiples compress, maybe the expected returns on all this AI investment don't quite materialize as quickly as hoped. That wealth effect could reverse sharply. Billions in paper wealth could vanish, and that could slam the brakes on consumer spending, pretty much regardless of what the last GDP report said. It's a major financial vulnerability.
And the policy side isn't set in stone either. Trade policy can change quickly. The risk of new tariffs or export controls that actually have teeth, that's still very much present.
That risk is absolutely live, yes. Especially for core goods, capital equipment orders, retaliation from trade partners is also still a possibility. But maybe the even bigger policy cliff isn't just trade. It's the risk of monetary policy staying tighter for longer because certain types of inflation just won't quit.
Okay, so pulling this together, if we accept this idea of a sort of mid-cycle pickup, but with really narrow leadership, what are the main vulnerabilities we should be tracking? Like the top 3 things to watch beyond the headline number?
Okay, number one, I'd say, is definitely policy cliff risk. And it's kind of a triple threat. It could be fresh tariffs or tougher export controls, like we said, or it could be fiscal stimulus finally fading and starting to drag on growth. Or, and this is crucial, central banks feeling forced to keep interest rates higher for longer because underlying inflation is too sticky. Specifically, you want to watch core services inflation excluding housing.
Right, let's unpack that one quickly. Why that specific measure? Why is it the one that could keep central banks hawkish?
Because it strips out volatile energy and food, and also the direct impact of housing costs, which have their own dynamics. What's left is heavily influenced by wages, particularly in service industries. If that measure stays stubbornly high, it tells central banks that underlying domestic price pressures, driven by labor costs, aren't cooling fast enough. And if wage growth doesn't slow sufficiently, they might feel they have no choice but to keep rates high, even if other parts of the economy are weakening. That decision could cap the whole expansion.
Got it. So policy risk trade, fiscal drag, or sticky inflation forcing high rates. That's vulnerability 1. What's number 2?
Second is earnings breadth, or rather the lack of it. Right now, profit growth is really concentrated at the top end, those AI leaders, defense contractors, maybe high-end travel and luxury. For this expansion to be durable, to be resilient against shocks, you need to see profitability spreading out more widely, filtering down to small and mid-sized companies across different sectors. If it stays this top-heavy, the whole cycle is just much more vulnerable if those leading sectors hit a bump.
Okay, earnings need to broaden out. And the third vulnerability, it sounds like it relates back to that investment piece we discussed earlier.
Exactly. It's about capex diffusion. Is investment spreading beyond just the AI boom? Right now, IP spending is a big driver, but that can't carry the economy forever. A truly sustainable expansion needs broader capital spending. Investment in things like upgrading the electrical grid, building more housing, improving transportation, even just standard IT upgrades in regular manufacturing firms.
Yeah.
The basic plumbing. If all we see are orders for data centers while other capital goods orders stay weak, then this strength we're seeing in 2025 might just be a temporary capex mini-cycle related to AI, not the start of a broad, durable upswing. It could burn out.
Okay, this is really helpful. And for listeners who want to track this themselves, the sources actually give us some specific things to monitor over the next, say, 3 to 6 months, right? Kind of dashboard to test if this resilience holds up.
Yes, absolutely. There are concrete data points. First, keep a very close eye on those inflation metrics we just discussed. Core services, ex-housing inflation, and overall wage growth. If they're clearly trending down, that suggests the path to a soft landing is still open. If they stay sticky or reaccelerate, that flags up that policy cliff risk.
And for that delayed tariff impact, the wave you mentioned.
You need to watch goods price pass-through. Look specifically at prices in those tariff-heavy categories, appliances, electronics, clothing, especially during and after the holiday shopping season. Are companies finally passing those costs on? That's where you'd see it first.
Okay. And on the investment side, look beyond the tech giants.
Yes. Track capital goods orders outside of ICT information and communications technology. That tells you if the investment is broadening, if that CapEx diffusion is actually happening. Also, monitor credit indicators. Things like high-yield bond spreads the extra interest risky companies pay, and surveys on small business lending standards. If credit starts tightening for firms outside the mega-cap sphere, that's a big warning sign for stall risk.
Makes sense. And finally, this can't just be a U.S. story if it's truly global resilience.
Exactly. You have to check global diffusion. Look at indicators like the PMI surveys, purchasing managers' indexes, and employment data in places like the Euro area, and also emerging markets, excluding China. Is the momentum actually spreading, or is the U.S. sort of floating alone on a temporary cushion of fiscal spending and tech hype?
So the bottom line seems to be the global economy absorbed these shocks, trade wars, AI fears, not because it suddenly became immune, but because the buffers, particularly that fiscal push and the massive wealth effects from tech, were just exceptionally strong. The real question, the one to mull over, is what happens if, or perhaps when, those buffers start to deflate? Will the underlying narrowness of this growth be enough to keep things going when those delayed shocks, tariffs, higher rates finally make landfall? Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.